operating companies send a check back to Omaha. What percentage do the heads of the operating companies keep as a bonus, and how do you set that figure?
Well, we have different bonus arrangements, different companies. It'd be a big mistake with businesses with as many different economic characteristics or as varying economic characteristics as existing as they do with Berkshire to try and have some formula approach that paid managers in all of these different businesses based on a simple formula of one kind. So we have, I think, 4 businesses where they own a part of it, and we have varying arrangements with the various businesses. Some businesses, capital employed is unimportant. There simply isn't a way to employ a lot of capital. So we do not have a capital charge even at those businesses. We don't believe in going through a lot of machinations if it's going to involve peanuts at the end. So some businesses have a capital charge, some businesses don't have a capital charge. If they use a lot of capital, they're going to have a capital charge is what it amounts to. Some businesses are easy businesses, some businesses are tougher businesses. So we have different thresholds where things kick in based on it. We simply sit down and try and figure out, in the case of each business, what makes sense. And that usually isn't very hard to figure out. I mean, we want something that's fair. The best managers, we aren't going to change their behavior much by the compensation thing. We may a little bit in terms of teaching them how we think about capital employed, but in terms of their enthusiasm for the business, imagination and marketing and all that, basically, we usually buy businesses with those people in place. But it would be it'd be wrong not to treat people fairly, and they would resent it if they weren't treated fairly too, understandably. So we try to have a system that rewards the things that we want to have rewarded and treats them fairly in a way that they understand they're treated fairly. And I don't think we have any 2 businesses that have the same arrangement. They're different in each case. Incidentally, that applies in their policies too. We don't get into very seldom, I should say, maybe once or twice, but they have different arrangements in terms of compensating their employees. Some of our businesses have budgets, some of them don't. We don't have any budgets that come up to headquarters. We let 400 hitters swing the way they want to swing, and some of them, have a little different swings than others, but overall they're extremely effective, and we want them to feel like they own their own business. But, if somebody that's independently wealthy sold us a business and we started telling them how to swing, they would tell us what we could do with it very quickly, because they don't need that in life. So what we have to do is create a situation or maintain a situation where they're having more fun doing what they're doing than anything else they can do in life. And that's what we're designing for. And then we have to treat them fairly in respect to that. Charlie? Nothing to add. Zone 5?
Roger Hill from Racine, Wisconsin. Gentlemen, a little change of pace. Could we get your opinion on the present situation with international exchange? Do you think we have a dollar problem, or is the Japanese have a yen problem?
Well, I'm going to let Charlie answer that.
I have no comment.
That's a very good question, but the trouble is, anytime I say that's a very good question, it's probably because I don't know the answer. I don't know the answer to that. Foreign exchange baffles me, frankly. I mean, I think in terms of purchasing power parity, because that's a natural way to approach it. But purchasing power parity does not work very well as a guide to how exchange values will behave in any shorter, medium, or maybe even long term, because the world adapts in different ways. Sometimes it adapts by high rates of inflation to a sinking currency. Usually it does. It hasn't done that in respect to ours, but we're only sinking relative to a couple of other important currencies. I don't have a great answer for you on that. Sorry. Zone 6.
Hi, I'm Howard Winston from Cincinnati, Ohio. First, I wanted to thank you and Charlie for your sharing your time with us today. My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. given that many in the audience today have a lower dollar investment threshold,
Do these stocks have names?
well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years as I looked at things. Clearly, you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. I just don't look at that universe anymore. Sometimes people send me annual reports, or I get letters from managers, and they say, well, I've got this wonderful thing, and I usually know ahead of time, but I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money, that there almost always are some significant inefficiency someplace to find things. That I've mentioned to some people, when I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then.
Charlie? Well, I can remember when you bought one membership in some duck club that had oil in it when you were young.
Yeah,
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlan, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, is that an efficient market or not? $29,000 for $20,000 of cash plus $11,000 of royalty income and 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future. Zone 1. Don't think the mic.
How do Berkshire and Berkshire companies protect themselves against lawsuit-happy lawyers? And is it possible for American businesses to survive the financial and time-consuming costs of dealing with lawyers?
Well, it's a good question, and we've probably had less litigation than any company that, with a $25 billion market value in America. But it's, and we were sued one time at Blue Chip Stamps. What was it for, Charlie? And how many billion by some guy?
lots.
Yeah, it was, you cannot protect yourself against lawsuits, and there's certainly a lot of frivolous ones. Like I say, it's not been a drain on our time or money, but particularly time to date. And I think one thing you'd have to do is that if you ran into anything of that sort, you would not pay, and you would try to make life comparably difficult for the other party as they made it for you. But that has not been our experience so far. Charlie?
Yeah, well, I can tell an Omaha story on that one, which demonstrates the Berkshire Hathaway technique for minimizing lawsuits. When I was a very young boy, I said to my father, who was a practicing lawyer here in Omaha, "Why do you do so much work for X, who was an overreaching blowhard? And so little work for Grant McFadden, who is such a wonderful man." And my father looked at me as though I was slightly slow in the head, and he said, "Charlie," he said, "Grant McFadden treats his employees right, his customers right, everybody right. When he gets involved with somebody who's a little nuts, he gets up from his desk and walks to where they are and extricates himself as soon as he can." And he says, "Charlie, a man like Grant McFadden doesn't have enough law business to keep you in school." "Ah, but X," he said, "he's a walking minefield of continuous legal troubles, and he's a wonderful client for a lawyer." Now, my father was trying to teach me, and I must say it worked beautifully, because I decided that I would adopt the Grant McFadden approach. And I would argue that Warren independently reached the same approach very early in life. Boy, has that saved us a lot of trouble. It is a good system.
We basically have the attitude that you can't make a good deal with a bad person. And that means we just forget about it. I mean, we don't try and protect ourselves by contracts or getting into all kinds of, due diligence, or we just forget about it. We can do fine over time dealing with people that we like and admire and trust. So we have never, and a lot of people do get the idea, because the bad actor will tend to try and tantalize you in one way or another, and you won't win. It just pays to avoid them. And we started out with that attitude, and maybe one or two experiences have convinced us even more so that that's the way to play the game. Zone 2.
I'm Clarence Cafferty from Long Pine, Nebraska. I'd like to know if we can get another 400 hitter by starting another Borsheim store someplace in this United States.
Well, it's an interesting question about both the Borsheims and the Mart. I mean, they and of course they're owned, as you probably know, historically by the same family. I mean, it was Mrs. B's sister's family that bought Borsheim, but in effect started it virtually from scratch. And both of those institutions offer this incredible selection, low prices brought about by huge volume, low operating costs, and all of that. Operating multiple locations, you would get some benefit, obviously, from the name and the reputation, but you would lose something in terms of the amount of selection that could be offered. There's $50 million plus at retail of jewelry at Borsheim's one location. Well, when someone wants to buy a ring or a pearl necklace or something of the sort, they can see more offerings at a place like that than they possibly could at somebody who's trying to maintain inventory at 20 or 50 locations. Similarly, that gives us a volume out of a given location that results in operating costs that, again, can't be matched if you have an enormous number of locations. So I think those businesses tend to be more successful in that particular mode as one location businesses. Now, Helzberg's will be bringing merchandise to people all over the country at malls, and they will do through that mode of operation. They perform that exceptionally well. But Borsheim's can't be Helzberg's, and Helzberg's can't be Borsheim's. They're both going for two different customers to some degree. And Saul Price, Charlie's friend who started the Price Club, the first big wholesale club said that part of his success was due to figuring out the customer he didn't want. I think that's right. Isn't it? Right. Yeah, and you have to figure out what you're good at, who you really can offer something special to. Borstein's offer something very special to people, but in part it comes about through being at one location. You can see more of almost any kind of jewelry you want there than you're going to see virtually any place in the world. And that will bring people there, or it will bring male people there. And that gives you operating costs that are 20 percentage points off of what somebody else will be doing without that pulling power. And that in turn enables you to offer the lower prices, which keep the circle going. I mean, it's very hard to replicate something like that. And trying to do it in 10 spots probably wouldn't work well. But it's a question you ask yourself as you go along, obviously. McDonald's certainly did well by deciding to open a second store. Zone 3?
Warren, I'm Frank Martin from Elkhart, Indiana. You have written extensively on the subject of the immutability of return on equity for American industry as a whole, being stuck in the 12 to 13% range. What forces do you see, since we're above the mean, to cause that number to regress to the mean over time?
Yeah, it's true. It has been higher in the last few years, although Fortune's got some interesting figures in the current issue on the 500 that shows decade by decade what the return has been on the Fortune 500 group, which is a shifting group, of course. And it's tended to stick, although I would say it was more between 12 and 13 than 11 and 12 probably in that one. The return to some extent in certain businesses has gotten a big kick because they finally put the health liabilities on the balance sheet and therefore reduce equity. So if you, anything you do that tends to pull down equity, if it doesn't change your ability to do the same sales volume, it's leveraged American business in effect by putting the health liabilities on the balance sheet. It may be wrong. It may be the business can earn 15% or so, but I think competitive factors tend to, over time, keep pushing that number down somewhat. And 12 or 13, when you think about it, is not bad at all. I mean, it's a level with 7% interest rates that allows stocks and equity to be worth much more when employed in equity than elsewhere in the world. But if I had to pick a figure for the next 10 years, I would pick some figure between 12 and 13, but that doesn't mean I'd be right on it. Charlie?
Yeah, I think all of those published averages overstate what's earned anyway. They're the biggest companies. They're the winners. They're the ones whose stock sells at high multiples so they can issue it to other people for high earning assets. And many of the low return people are constantly being dropped out of the figures. Now you can say that was true in the past too, but it would be remarkable to me if on average American business earned 13% on capital after taxes.
Those figures, incidentally, isn't a huge item, but it's not totally insignificant. They don't show as a cost, for example, the cost of stock options, and the American shareholders paid that. So the American shareholder has not gotten the returns on equity shown by those numbers, although it's not a huge factor. But I wouldn't be surprised if it was 2 or 3/10% just for that one cost that's omitted. If you let me omit my costs, I can show a very high return on equity. Zone 4.
Jeff Peskin from New York, and I have a question for you. It's really more of an observation in that you've written about when you look at acquiring a business, you look at a lot at how they allocate capital. And my question is, once you acquire a stake in a company, do you find that just by the fact that you are helping doing the allocation of capital and doing the compensation, that alone makes a company have a lot higher return? Or is there some benefit by the fact that you own, or some major shareholder owns a big slug of the company, that also allows a company to increase its return on capital?
Well, that's a good question. The answer is sort of some of the time, some of the places. There's no question in a business that earns a high rate on capital that doesn't have natural ways to employ that money within the business, that we actually may contribute significantly to the long-term results of that business by taking the capital out, because if they don't have a place to use it, nevertheless, they might well use it someplace. And we have the whole universe to spread that money over. So we can take the money that earned in some operating business and we can buy part of the Coca-Cola company with it and buy into another wonderful business, whereas very few managements probably would do that. So there's an advantage there. Now, on the other hand, Helzberg, for example, will probably grow very substantially. They'll probably use all the capital they generate. Maybe they'll even use more. Well, they don't really need us for that. I mean, they would have done that under any circumstances. We may actually give them the ability to grow even a little faster, because if a company, and these are not the Helzberg figures, but if a company is earning 20% on equity but can grow 25% a year, they're going to feel equity strains at some point. And we obviously would love the idea of supplying extra capital that would earn 20% on equity. So there can be some advantage to having us as a parent in terms of sending capital to the business as well as taking capital from the business. We also, I think, can be helpful in some situations in that once we are there, a lot of the rituals of, particularly in a public company, but a lot of the things that people waste time doing in business, they don't have to do with us. I mean, they're an awful lot of time spent in some businesses just preparing for committee meetings and directors meetings and all kinds of things like that, show and tell stuff. And none of that's needed with us. We won't go near them. And so we really free them up to spend 100% of the time thinking about what is good for the business over time. If they have extra money, they don't have to worry about what to do with it. If they need extra money for a good business, it'll be supplied. So there are some advantages that way. And I guess, Charlie, can you think of any further?
Yeah, I think our chief contribution to the businesses we acquire is what we don't do.
It's hard to continue to grow at the rate you've grown in the past because the company has gotten so big. And I'm wondering if you could elaborate a little bit on that. My second question, which is totally unrelated, but I've also read where you're very good with numbers, with working things in your head, and I'm totally a rookie when it comes to economics and accounting and things like that, but I'm very good with numbers and keeping things in my head, and I'm wondering if there's some way a mathematician who knows very little about the business world, what I could read or what I could do to learn how better to invest and how you did that.
But going to the first question, when you say it's going to be hard, it's going to be impossible. I mean, that's the answer. We cannot compound money at 23% from a $12 billion base. We don't know how to do that, and it would be a mistake for anybody to think that we could come close to that. We think we can do okay with money, but we did not start with a $12 billion base, and we've never seen anybody in the world compound numbers like that at that rate. So we'll forget it, that part of it. But there are intelligent things we can be doing. The second part of the question, I don't think any great amount of mathematical aptitude is not aptitude, but mathematical knowledge advanced math is of no use in the investment process. An understanding of mathematical relationships, sort of an ability to quantify a numeracy, as they call it, I think that's generally helpful in investments, because it's something that tells you when things make sense or don't make sense, or sort of how an item in one area relates to something someplace else. But that doesn't really require any great mathematical ability. It really requires sort of a mathematical awareness and a numeracy. And I think it is a help to be able to see that. I mean, I think Charlie and I probably, when we read about one business, we're always thinking of it against a screen of dozens of businesses. It's just sort of automatic. And but that's just like a ball, a scout in baseball thinking about one baseball player against an alternative. I mean, you only have a given number on the squad, and thinking, one guy may be a little faster, one guy can hit a little better, all of that sort of thing. And it's always in your mind you're prioritizing and selecting in some manner. My own feeling about the best way to apply that is just to read everything in sight. I mean, if you're reading a few hundred annual reports a year and you've read Graham and Fisher and a few things, you'll soon see whether it kind of falls into place or not. Charlie?
Yeah. I think the set of numbers, the one set of numbers in America that are the best quick guide to measuring one business against another are the value line numbers.
I'd agree with that.
That stuff on the log scale paper going back 15 years, that is the best one-shot description of a lot of big businesses that exists in America. I can't imagine anybody being in the investment business involving common stocks without that thing on the shelf.
And if you sort of have in your head how all of that looks in different industries and different businesses, then you've got a backdrop against which to measure. I mean, if you never watched a baseball game and never seen a statistic on it, you wouldn't know whether a 300 hitter was a good hitter or not. You have to have some kind of a mosaic there that your thinking is implanted against, in effect. And the value line figures, they cycle it every 13 weeks, and if you ripple through that, you'll have a pretty good idea of what's happened over time in American business.
By the way, I pay no attention to their timeliness ratings or stock ratings or no.
None of that means anything. It's too bad they have to put that there, but it's the statistical material, not the.
I would like to have that material going all the way back. They cut it off about, 15 years back?
Yeah, but I saved the old ones.
Yeah. Well, I wish I had that in the office, but I don't.
Yeah, Charlie and I maybe even I do it more. We tend to go back, and if I'm buying Coca-Cola, I'll probably go back and read the Fortune articles from the 1930s on it or something. I like a lot of historical background on things just to sort of get it in my head as to how the business has evolved over time and what's been permanent and what hasn't been permanent and all of that. I probably do that more for fun than for actually decision making. But I think it is. I think if you think about it, we're trying to buy businesses we want to own forever, and if you're thinking that way, you might as well see what it's been like to own them forever and look back a ways. Zone 6.
I'm Stuart Horish from Salina, Kansas. When you first bought part of Wells Fargo a few years back, I looked at it and I couldn't tell it was any better than any of the other banks. I think now anybody that would look at it can tell it's better than almost any bank. Now you've bought PNC Bank, and again, I can't see how it's distinguished from any of the other banks. What did you see in PNC Bank that made you select it over all the other banks that were available?
Well, we're not going to get any stock advice on that.
That's a great question.
I think that going back to Wells, it was very clear that I knew something about Carl Reichert and to a lesser extent at that time Paul Hazen from having met him and also from having read a lot of things they said. So they were different. They were certainly different than the typical banker. And then the question was how much did that difference make in terms of how they would run the place. And they ran into some very heavy seas subsequently. And I think probably the difference, I probably think those human differences that were perceived earlier are what enabled them to come through as well as they did. But that's about all I can say on banks.
Well, we might add to that slightly because that Wells Fargo thing is a very interesting example. They had a huge concentration of real estate lending, a field in which people took there was the biggest collapse in 40 or 50 years in that field. So that if they had been destined to suffer, the same sort of average loss per real estate loan that an ordinary bank would have suffered. The place would have been broke. So we were basically betting that their real estate lending was way better than average. And indeed, it was. And they also handled it on the way down way better than average. So you can argue that everybody else was looking at this horrible concentration of real estate loans and this sea of troubles in the real estate field and in bankers to the real estate field, and they just assumed that Wells Fargo was going to go broke. And we figured, no, that since their loans were way higher quality and their loan collection methods were way higher quality than others, it would be all right. And so it worked out.
Probably couldn't have told that. If we hadn't gone a little further, though, then just looking at the numbers, we would not have been able to make that decision. Zone 1.
David Carr, Durham, North Carolina. TAM Brands and U.S. Tobacco are two companies which are primarily single focused product companies that seem to possibly have some barriers to growth in unit sales and pricing, and have employed a strategy of returning cash to shareholders through stock repurchases. Both companies have at times when they thought the stock was at a discount to intrinsic value used debt to accentuate the repurchases. Those companies recently have talked about problems with going into a negative stated shareholders equity position through the use of additional debt to repurchase more shares at a time when both companies believe their stock's very cheap, and they appear to have the type of long-term cash flow that would at least allow that. Would you comment on the at least accounting treatment and the stated shareholders equity, and if you think that should be a real concern for management in those areas?
What was the first company besides U.S. Tobacco?
TAM Brands.
TAM Brands?
Yes.
Yeah, I don't think there's anything magic about whether shareholder equity is positive or negative. The Coca-Cola has a shareholder equity of $5 billion. It has a market value of $75 billion or so. Now, they're not going to do it, and I'm not going to recommend it. But if they were to spend $10 billion buying in their stock, they would have a negative shareholders equity of $5 billion. Their credit would be sound. I mean, if somebody else were to buy the company for $75 billion, they'd have $5 billion of tangible assets and $70 billion of intangible assets. And there is nothing magic about a company having a positive shareholders equity, and it isn't done very often. And I can't even think of a case where it's been done, but it may have been. But I see nothing wrong with a company having a negative shareholders equity, although maybe prohibited by the state in which they're incorporated in terms of repurchasing shares at a time that would produce that. You'd have to look at the state law on that. But any time a company in an LBO or something is bought out at some very large number over book value, in effect, they're creating a negative. If they borrow enough money out of it, they're creating a negative shareholders equity in terms of the previous shareholders equity. It's just a fiction, the numbers between the two organizations. Now, you should buy in your stock when you don't have a use for the money, and that could be management specific. I mean, some managements might have a use for the money if their field of capital allocation were large enough, whereas another management that was more specialized in their own business might not. But once a company has attended to the things that are required or advantageous for the present business, I think reacquisition of stock is a very logical thing to consider, as long as you don't think you're paying more than the intrinsic value of the business in doing it. And obviously, the bigger the discount from intrinsic value, the more compelling that particular use of money is. Charlie?
I've got nothing to add. Generally speaking, maybe Coca-Cola can have a negative equity, but I don't think it would be a good idea for General Motors. I think there's something to be said for a positive shareholders equity.
Zone 3.
Edward Barr, Lexington, Kentucky. I had a twofold question. Number one, you mentioned American Express earlier, and I was curious as to whether the fact that credit card usage is only 10% of all transactions, and that may continue to grow for some time going forward, was a factor in your decision. And the other part of the question pertains to the durability and permanence of the banking franchise with regard to alternative delivery channels that may appear over the next few years, including the possibility of the Microsoft Intuit merger.
Well, the specific number you mentioned about credit card usage and so on, that's not a big factor with us. We think credit cards are both here to stay and likely to grow to some extent, although at some point you start reaching limits, at least in terms of outstandings, that people make any sense. But the credit card field is a very big field. The question is who's got the edge in it, because everybody is going to want to be in it. They already are, and there are a lot of different ways you can play the game if you're in the credit card business, and you better have some way of playing one part of the game, preferably a large part, but you better have some way of playing one part of the game better than others, or natural capitalistic forces are going to grind you down. I mean, it's a business that people are willing to change their minds about what they do in. I mean, if you offer somebody a credit card that gives them some advantages that don't exist on their earlier card, people are quite willing to shift cards. So you need some kind of an edge in some particular segment of the market. So that the growth aspects overall of the market were not a big factor with us. It's really a question of figuring out who's going to win what game and who's going to lose what game. And what was the second question again on that?
The second question pertained to the permanence and durability of the banking franchise.
Oh yeah, sure.
And whether alternative delivery channels over the next few years may erode the durability of that, including the Microsoft Intuit merger.
Well, that's a good question. You're certainly seeing the value of bank branches diminish significantly. It used to be a point of enormous pride with managements and how many branches they had, and it was often political influence and everything else was called into to obtaining branch permits. And the world will change in banking probably in some very major ways over a 20 or 30 year period. Exactly what players will benefit and which ones will be hurt, it's a very tough question. But I would expect. I don't think I'd expect really significant change in banking over the next 5 years, but I'd certainly expect it over the next 20 years. And there are a lot of people that have their eye on that market, including Microsoft, as you mentioned. It may be to their advantage to hook up with the present players. I mean, I know it's certainly something that gets explored, but they may figure out a way to go around the present players too. And that's one investment consideration. Charlie?
Yeah, the interesting player that went around the rest was Merrill Lynch. Merrill Lynch went heavily into banking with its cash management accounts. And I don't think it's the only innovation that will come along.
What's the name of that book?
Yeah, I've forgotten. That's a marvelous book.
It's a great
Maybe Molly remembers it. What's that book you gave me? It was the history of the credit card.
Was it Joe Nocera's or? Yeah, Joe Nocera was the author. Don't remember the title, but came out about 6 months to a year ago. It's a terrific history of the credit card business. And if you read that, you will get some idea of the amount of change that can occur in something like the movement of money. And my guess is that if there's another edition of it in 20 years, there'll be plenty more to write about. So,
by the way, that is a fabulous book. Most of the people over here will not be able to put it down. I mean, for a book about economic development, it captures the human background in a very interesting way.
So zone 4, that seems far over there for zone 3. Yeah. Mm-hmm.
from Boulder, Colorado. I was wondering if you could comment on the moat you see around the castles of SunTrust and PNC.
Well, I don't think I should comment on anything on specific holdings like that, but so I would say you would look at those in a general way very much as you look at banking operations first, and then you try and figure out what are the specific strengths or weaknesses of both organizations. But there again, I don't want to spoil the fun for you. Charlie?
Nothing to add.
Zone 5.
My name is Bob McClure. I'm from the States, but I live in Singapore. About a week ago in the Asian Wall Street Journal, a remark was attributed to Mr. Munger, specifically that owning Salomon Brothers was like owning a casino with a restaurant in front. The casino alluding to the proprietary trading and the restaurant to the so-called client-driven business. If that attribution is correct or accurate, can you elaborate on why you view the business in that way?
I don't think it's entirely correct, but I have a pithy way of speaking on occasion. And I frequently speak in a way that works with an in-group, but wouldn't necessarily work everywhere else. And every once in a while, when you take one of those wise-ass comments out of context, why, I very much wish that it hadn't occurred. This was such a case.
Alrighty, I'm eating downstairs. Definitely want to come up here and eat. So I'm gonna take my phone with me. I think I gotta do something anyways. So I'll be down there probably 15-20 minutes, and I'll come back up afterwards. Alrighty. I'm back. Not for long because I gotta wait on this thing.